Greenwashing. What is it? Greenwashing is the practice of making products, services, companies, or investments appear more environmentally friendly than they truly are, usually through selective disclosure, vague language, or misleading visuals. In plain terms, it is marketing dressed up as sustainability, where the reality of impacts does not match the rhetoric or the imagery of leaves, oceans, and smiling wildlife. A brief origin story helps. The term greenwashing gained traction in the late 1980s, popularized by critiques of hotel cards that asked guests to reuse towels to save the planet, while the hotels did little else to reduce their footprints. Through the 1990s and early 2000s, environmental claims multiplied on labels and in advertisements, and watchdogs began to catalog recurring tricks. Lists like the 7 Sins of Greenwashing drew attention to patterns such as hidden trade-offs and meaningless seals. The rise of climate targets in the 2010s and beyond added a new frontier: corporate carbon pledges that promised far more than they delivered, often leaning on offsets of doubtful quality. Why does greenwashing happen? Incentives and information. Consumers and investors increasingly value sustainability, and firms want to capture that demand. But measuring real environmental performance is technically hard and sometimes costly. The gap between what is easy to say and what is hard to do creates temptation. Add fragmented standards, inconsistent data, and the human tendency to prefer good news, and the conditions are ripe for overclaiming. It is useful to recognize the common forms greenwashing takes. First, vagueness. Terms like eco-friendly, all-natural, or clean, without specific, verifiable criteria. Second, irrelevance. Trumpeting a feature that is technically true, but not actually helpful, such as CFC-free, for products where chlorofluorocarbons were already banned long ago. Third, hidden trade-offs. Highlighting one green attribute while ignoring bigger harms elsewhere in the product's life cycle, as when a package is recyclable, but the contents are produced with high water stress. Fourth, lesser of two evils framing, claiming a slightly better footprint within a fundamentally harmful category. Fifth, no proof, bold assertions without accessible evidence or third-party verification. Sixth, suggestive imagery and faux labels, leaves, earth tone palettes, or invented seals that mimic independent certifications. Finally, ambitious pledges with fuzzy pathways, far-off net zero goals with no credible interim milestones. The economics of greenwashing matter because it misallocates capital and distorts competition. Think of a market for lemons dynamic. If buyers cannot distinguish genuinely lower impact goods from slickly marketed ones, they underpay for the real thing and overpay for the pretenders. Over time, truthful producers face weaker incentives to invest in costly improvements, and average quality falls. There is also a negative externality. The public forms cynicism about sustainability claims, which raises the cost of communicating even for honest actors. In finance, impact-washed or climate-washed funds can steer savings toward portfolios that barely differ from the market, while charging premium fees for a green label. How can you spot and counter greenwashing? Start with specificity. Credible claims name the metric, the boundary, the baseline, and the time frame. Cut life cycle emissions by 1/3 from a 2019 baseline by the end of this decade is meaningful. Go greener is not. Look for third-party standards and audits that are well known in their domain, like credible forestry, building, or energy certifications. Scrutinize scope. Do the numbers cover direct emissions, purchased energy, and the upstream and downstream value chain, often called Scope 1, Scope 2, and Scope 3. Check for interim targets, not just distant ambitions, and for capital expenditure that aligns with the plan. In consumer goods, read the fine print about recyclability and recycled content. A package that is technically recyclable, in theory, may not be recycled in practice if local facilities cannot process it. Offsets deserve special attention. High-quality credits can finance genuine conservation or removal, but weak offsets risk double counting, impermanence, or a lack of additionality. If a company's climate plan relies heavily on cheap offsets while its core operations remain unchanged, that is a red flag. Better practice prioritizes real reductions in operational and value chain emissions, with offsets used sparingly and transparently for residual, hard-to-abate segments. Regulation is catching up, though unevenly. Advertising and securities authorities in many jurisdictions have issued guidance or brought cases against misleading environmental claims. Product labels in areas like energy efficiency and appliances are increasingly standardized, and competition authorities have warned against vague terms without substantiation. In capital markets, disclosure rules are pushing companies and funds toward clearer, comparable reporting on climate risks and impacts. The intent is not to police good intentions, but to ensure that claims are fair, truthful, and decision useful. Companies that want to avoid greenwashing can follow a practical playbook. First, anchor sustainability in the business model and unit economics, not just in marketing. Second, measure what matters with robust methods like life cycle assessment, and disclose methods and uncertainties in plain language. Third, set staged, science-based targets with public progress updates and independent assurance. Fourth, align lobbying and trade association memberships with stated climate goals. Credibility vanishes if a firm's public stance and behind-the-scenes advocacy diverge. Fifth, bring customers and communities into design and testing, because usability and adoption determine whether green features deliver real-world impact. A few curiosities before we close. 1. Greenhushing has emerged as the quieter cousin of greenwashing, where firms undercommunicate legitimate progress to avoid backlash. That can also hurt transparency and learning. 2. Greenwashing describes aspirational language that stops short of concrete commitments. It sounds hopeful, but does not bind behavior. 3. The color green is itself historical branding, shorthand, from financial ledgers to environmental movements. It evokes growth and nature, which makes it powerful and risky in marketing contexts. 4. Humor and satire have become tools of accountability, as ad-busting campaigns and social media callouts pressure firms to match claims with conduct. In one sentence, greenwashing is the inflation or fabrication of environmental virtue, which misleads buyers and investors, undermines real progress, and can be countered by precise metrics, third-party verification, honest trade-offs, and aligned capital. Above, I leave you more videos so you can keep learning law. Remember to leave us a like and subscribe.